All right, listen very closely because you will learn how to create a trading plan that prints money consistently. So diving straight into it, what are the frameworks of a trading plan? The frameworks of a trading plan and how every trading plan works is its consistent boundaries. So what does that mean, consistent boundaries? I'm going to give you a mentorship insight right here, a money-making team insight. In the money-making team, we use 6 foundational levels. Those 6 foundational levels create a trading plan. The first foundational level is a bias. Then the second one is a narrative. The third one is a boundary. The fourth one is a target. The fifth one is our entry pattern. And the sixth one is our risk management. Those 6 again create that trading plan. So what does that have to do with boundaries? Well, it's a checklist. It's sort of a filtering process. You're consistently going through a filtering process. We first need to find that bias. If we find that bias, that creates a boundary to now go into the narrative. If we can successfully find that narrative, that now creates the boundary to go into the third foundational level, the actual boundary. This wouldn't be an Ario video if I didn't define everything that I'm going to mention right here. So if those foundational levels are not clear just yet, don't worry, we are going to dive into every single one of them. So the first foundational level was bias. How can we define bias? If we define bias, it is simply the direction. The direction leads to the draw on liquidity. What is a draw on liquidity? A draw on liquidity is the closest PD array that we are reaching for. So what does that look like? Well, if we go into the monthly time frame here on Euro US dollar, then again, we can see right now that on the monthly time frame, we have this monthly verify gap that we are not respecting. As in, we are trading above it. That already indicates to us, like we mentioned, that is a bit weird, right? We should ideally respect that to then continue lower. So here we are potentially creating a bullish fair value gap right there. Now, very easily done is the direction right there is looking at what is the most recent candle doing. Is it showing bullish or bearish intention? Where the most recent monthly candle, what has it been doing? It's been showing bullish intention. That's as easy as it gets for a bias. Simply understanding the monthly candle. What is it doing? Then the next part of that bias, because we also said a draw on liquidity. So the closest PD rate that we see. What is the closest premium array that we are likely heading towards? It's potentially this high right there. Now that high is currently quite far. So at that moment in time, let's dive into the weekly time frame to find a little bit of closer premium array. Then on the weekly time frame, we are seeing this swing high, which is just simply a premium array. So that premium array right there is the closest PD array that we can reach for. That leads us to our short-term draw on liquidity right there. With the long-term draw on liquidity potentially being that monthly high that is sitting right here. So what have we just done? We have just gone over bias. We now understand that there's a high probability that price might want to trade higher. This is exactly what you need in the first step of your trading plan, which can also be quite difficult, right? But usually it's your own mind that likes to complicate it. Or it's other mentors and other gurus out there that try to throw 1,000 concepts at you to complicate it for you. So you're getting help in complicating the most difficult job in the entire world. Great job. You're doing the exact opposite of what we need to do. So if you struggle with bias, then all I want you to do right there is understanding the most recent candles. And I just want you to follow what I do because I start on a monthly time frame. And usually people come to me and they struggle with bias. And the first thing I see them do is they go into the 1 hour time frame to start their bias. Yes, I can understand why you are struggling with bias if you start on the 1 hour time frame. Don't get me wrong, using the 1 hour as your bias can definitely work after years of experience. After first following these steps right here, that is when it can work. If we go into the 1 hour time frame, for example, then right here, we are having a lot of candles. So here we need to take into account, let's say about, what is that? 85 candles. So on the 1 hour, it might be very messy right here to actually get to potential buys. Because if we ignored this monthly fair value gap right there, and we just had this price action, then what would you do at this moment in time? What are you doing here? Are you being bearish? Are you being bullish? Without knowing what's above you, without knowing the time frames above you. Because yes, with experience, you can do this. But even with experience, why don't you make such a difficult task like trading a little bit easier for yourself by just going into the monthly time frame first and seeing, all right, what is the next monthly candle likely going to do? Is it going to expand higher or expand lower? How many 1 hour candles do you need to predict in that monthly candle right there? Well, if you just know the monthly candle where it's likely going to head towards, then you already have a great indication of what the 1 hour candles want to do. So make it yourself a little bit easier right here and just simply look at what is the most recent monthly candle doing. Towards which side of the market are we potentially creating a fair value gap? Are we creating a new fair value gap here to the bearish side or to the bullish side? Well, potentially right now towards the bullish side. Because after not continuing lower off of that bearish fair value gap, we are now potentially creating a bullish fair value gap. That already tells you, hey, I think we are bullish. Perfect. All you need to know. Next thing, what are we likely heading towards if we are bullish? That premium array, perfect, great job. You have just passed the boundary of bias. So right now, we need a narrative. A narrative is, again, let us define it. A narrative is, how are we going to deliver into that draw on liquidity? So the draw on liquidity that we had established right here, how are we going to deliver into that? So which PD array is going to be responsible for price to push into that draw on liquidity? Which again creates the beautiful sentence that I've been saying for a long time now. If we are going higher, where are we likely going higher from? Well, on the weekly and on the monthly, we could see that we didn't have a clear discount array just yet, right? And in the form of a clear discount array, let's define that. A clear discount array right there is when we at least have a fair value gap. The fair value gaps validate the other PD arrays for me. So in order for us to have an order block, we also need a fair value gap. So the first thing is, again, yes, we might create this order block right there, but that is not an order block without a fair value gap. So first we need to wait for a fair value gap being created right there, which we currently don't have. So on the weekly, monthly, we don't have discount arrays to continue higher off of just yet. Perfect. Let's go down one time frame into the daily. Then on the daily time frame, we can see that we do have that narrative, that PD array that could be responsible right there to push price higher into that draw on liquidity sitting right there. So that leads us to the narrative. The bias is, where are we heading towards? The narrative is, how are we actually getting there? Which, if we have a bullish bias, then it's simply the narrative, a discount array that's going to push us into the draw on liquidity. If we have a bearish bias, it's simply a premium array that will push us into the draw on liquidity again. With, of course, if you have a bullish bias, you're aiming for a premium array. If you have a bearish bias, you're aiming for a discount array. So we have a bullish bias here. We're aiming for a premium array. That is the first step. The second step is, which discount array can be responsible for pushing into that premium array? This daily fair value gap sitting right there. It's just simply said, the first discount array that we encounter on any time frame. So right here, what I would also want you to do is, we went from the monthly, weekly into the daily. And the daily is where I now found my discount array that I want to trade off of. That is where you stop. That daily discount array will be responsible for us now being able to go into the lower time frame, which is again an example we will have later on in this video. But this is where you now want to stop, because this gives you a lot of context to work with, meaning that that daily discount array is what you can trade towards and trade off of, which again, I'll show you an example later on. So right now, that daily discount array also creates the boundary. With that third foundational level, the boundary, I mean that is the PD array that will push price higher. In other words, that is where we can go into our entry pattern timeframe to now look for our actual entry pattern to potentially get involved. And this is also where you want to make use of your news days. So which day do you want to trade right there? The day that has news supporting the IDs. Basically what I'm doing right here is I'm going over videos and I'm combining all the videos into one video right now, where the news video right there is part of our time and price video. So on that next day that we had, on that Thursday, we had news supporting the ID of trading that day, as in we had US dollar red folder news. So there's volatility. So we know we can push higher. Perfect. The boundary is set. What is the target? Because before we get into an entry pattern, we need to first understand the overall target. The first target is very simple. When we are looking at the narrative and the boundary, we are looking at a PD array to trade off of. In this case, it's the daily fair value gap right there. On the same exact time frame, we are going to encounter a first premium array, which is this high, that swing high right now. Can also be a previous day high, for example, or a previous day low. So simply said, the foundational level number 4, that target, is the first opposing PD array. Opposing meaning if you are trading off of a discount array, then of course an opposing PD array is a premium array in that case. So this right there is the first premium array that we encounter. Perfect. So that is our first target. And that is important to understand because that allows us to know where we want to look at for our 15-minute entries. We want to look at our 15-minute entries from this discount array towards that premium array that is sitting right there. That overall creates context. So we have boundary set right there. Perfect. We have the target set right there. All right, perfect. Then what is it time for? It is time to wait for that discount array, the daily fair value gap, to be traded into, to then potentially show us our entry pattern. So if we now dive into the 15-minute time frame, and on the 15-minute time frame, we can see that we are slowly getting into that daily fair value gap right there, and now we can expect higher prices off of that. Now, what do we use as our entry pattern? An entry pattern is very funny actually, because it's the same exact thing as you would like to see on the higher time frame. The only thing you're doing is you're going into the lower time frame, most likely, and you are now looking to actually execute on the trading ID. This is also where we want to make use of kill zones, again referring to the time and price video. So right here we had our sharp turn, and now I'm referring to the previous video that we had. You don't need market structure shift, you just need fair value gaps. Now, whilst I'm going over this entry pattern right here, you might have noticed that every single boundary we have used thus far basically consists of fair value gaps. Isn't it funny that you get thrown so many concepts at you? And the example I'm showing you here is where I made $13,000 in one single trading day just using fair value gaps. And that's the exact video I also made with this example. Right now, I'm just showing you the framework behind it. So to dive into the framework a little bit deeper, we also made the previous video on you just need fair value gaps, you don't need the market structure shift. Where right here, we had that first fair value gap higher right there, and then we had that second fair value gap higher right there. That second fair value gap higher, that is exactly where you are looking to get involved. Which this could have very well been the daily time frame. It's exactly the daily time frame actually, because on the daily time frame we were also expecting that move higher from the fair value gap, where on the 15-minute we're just doing the exact same right there, targeting a nice 1 to 2 overall. Perfect. And then eventually we deliver there. But there's one last boundary as well, because the other boundary we had for the last foundational level was what? Risk management. Risk management is where you need to understand your risk percentage. How much are you willing to risk on a certain setup? Ideally, if you're just starting out, try 0.5%. You can work your way up towards even a 2% eventually once you are profitable and consistently profitable. You need to know whether you want to take partials. I personally, just to give you a quick insight, I don't take any partials. I don't like partials. I don't really see the benefit from them for myself. Of course, that is attuned to my own trading plan. Because if you are targeting very far and you're targeting a high RR, then I could definitely see, if we target that context high right there in the form of that swing high we determined on the daily, then I could definitely see why you want to take profits and why you would want to take a partial at 1 to 2. For example, take 80% off right there and then target the highs. Depending on your data, if that's really worth it, if it's not more worth it to just keep holding towards a 1 to 3 right there and then close the full position, depending on your data. Then of course, we also need to have a break-even rule. A break-even rule is quite simple. And again, it's simply understanding where does price have no reason to come back to. So at this moment in time right there, let's say we didn't hit take profit yet. Would price now have a reason to come back to our entry level that is sitting right there? Well, we do have this fair value gap right there, and that swing low that is right there is inside the fair value gap. The first discount array that price encounters in that specific leg, so in that leg higher right there, is this fair value gap. Is it very logical for price to come all the way down there towards that low, towards our entry right there, before, for example, it hits our take profit around there? No. So the fair value gaps right there also told us we can already go break even, because there's no real reason to now come back towards our entry level right there. But if we now zoom out and let's say this trade right there did already hit take profit, what can we do? Well, to make it ourselves easy again, we can look to navigate all this price action on the 15-minute and try to take into account all those candles right there and try to predict exactly which low is going to hold, etc. Why not just simply zoom out one time frame? Because if we look at the 1 hour time frame, and this is purely why I'm so flabbergasted a lot of times when I open my social media, is because people try to trade this on a 5-minute time frame. Whilst what I'm doing and what a lot of people are doing that are extremely profitable in the money making team is just simply zooming out on the 1 hour time frame, seeing this 1 hour fair value gap right there and thinking, okay, if we want to go higher, we are going higher off of that. And then we cover this low right there. Perfect. Okay, what was the original target of foundational level number 4? That high. Okay, well, continue higher, take profit, make money. Perfect. Thumbs up. It's like, it doesn't need to be that complicated. Now, for that entry pattern, it is, of course, also important to understand that with the previous video, you always want to focus on either the float or the odd. So focus on that first line of defense or that overlapping defense. Which one do you want to enter on? And first, only stick to that particular entry pattern. So it's a constant repeatable process, constantly over and over and over. You can do the exact same thing, the exact same entry pattern, the same time frames in combination, and the same process over and over and over. Now, you can also see that the concepts here, they help you flow around the framework, because the foundational levels right there, they create again that framework of the trading plan. The concepts help you reach the ideas of a bias, of a narrative, of a boundary, of a target, of an entry pattern, of a risk management. So you can probably also see right now where if you were to incorporate something else from another mentor, for example, that's not going to work. Because let's say here you now incorporate another concept, then you will always have a reason to go to the next boundary. You will always have a reason to go into the entry pattern because you have 1,000 PD rays on your chart. If you have 1,000 PD rays on your chart, then there's always a reason to go into the lower time frame, and there's always a reason to look at a new entry pattern. And if there's always a reason to look at an entry pattern, then is that high probability? No. Because if we trade every single thing, then that means that we are not trading any probabilities. We need to be able to differentiate that high probability condition from that low probability condition. And if we always have a trade ID, then is that going to be a high probability condition? No, it doesn't work like that. There's no light without dark, and there's no dark without light. So there needs to be two polar opposites. And that's the same in the market right there. We need to have low probability conditions, but also high probability conditions. The only way we can recognize them if we stick to a certain trading plan. It's very important. All right, now we have the next example here on Euro US dollar again, where we currently reached this draw liquidity. So what can we do? Well, there's a few things that we can do because overall we understand that we still have this higher draw liquidity. So we can continue towards that draw liquidity. Understanding that also means, again, we still have the same bias. The direction is the same. The draw liquidity changed. The draw liquidity can now even be refined towards this swing high sitting right there. So how are we going to deliver into that draw liquidity and into that draw liquidity sitting right there? Well, we need a new discount array to push higher from into the premium arrays. So what is the discount array? The discount array that we are now creating is that weekly fair value gap sitting right there. So that right there is the discount array that can be responsible to push price higher. But what did we mention in the previous example? If we have this weekly fair value gap, you work your way down from the monthly to the weekly. Once you find that narrative, where are we going higher from? And you find the PD rate that we are going higher from, or you find the PD rate that we are going lower from, of course, then you do not go down any time frames. As in, you do not go down any time frames to look for a new discount array to push higher from, because the higher time frame rules. As in, the higher the time frame, the stronger the time frame. So the monthly is the strongest. Then the weekly. So here, if we have a daily fair value gap sitting in this area right there, then that daily fair value gap is not going to be strong. It's not going to be high probability because there's simply a weekly fair value gap hovering below it. But we also mentioned those fair value gaps. We don't necessarily need to always trade off of them. We can also use them as a closer draw liquidity to trade towards them. Because at this moment in time, if we look at the details, we have two draw liquidities right here. The first draw liquidity and overall the draw liquidity is that high. Yes, but if we are continuing higher, then we are likely continuing higher off of that weekly fair value gap. So if we get the right signs that we want to trade into that weekly fair value gap, then that weekly fair value gap is also a draw on liquidity on its own. So here, if we dive into the daily time frame, then on the daily time frame, we can see that we have this high sitting right there. That high is now potentially getting swept. It's not really leaving behind a clear daily fair value gap higher as well. Absolutely perfect. Because right now it all starts clicking. Because if we don't have that daily fair value gap higher, what are we likely going to do? We are likely now indeed aiming for that weekly fair value gap right there. So the weekly fair value gap is our current draw on liquidity. How are we going to deliver into that weekly fair value gap? Well, on the daily, we can wait for a daily fair value gap lower. By the time we have a daily fair value gap lower, we likely already traded into the weekly fair value gap. So we want to go into a little bit of a lower time frame to find that new narrative, because we're still busy with the direction here. We have found the draw liquidity, the weekly fair value gap right there. That is the draw liquidity. Now we need to find that narrative. How are we going to deliver into that? Can we find a fair value gap lower to continue lower off of that into the weekly fair value gap? On the 4 hour, we can see that we have those 4 hour fair value gaps right there. But before we created those 4 hour fair value gaps, we already did something on the 1 hour time frame. Where on the 1 hour time frame, what are we seeing right there? This was before the creation of the 4 hour fair value gap. So right here, we have this fair value gap that we can continue lower from, making use of a kill zone right there That 1 hour is now our narrative. If we are going lower, where are we going lower from? That fair value gap, which also creates, again, that third foundation level of that boundary, which also creates that target, because the target right there is this right there. That is where you want to look, and that is where you are allowed to look right there for your 1 minute entries. Once we reach below that low, take a step back to create overall new narrative. Because yes, the draw on liquidity is still this weekly fair value gap that we have below right there, but we also need to understand that we can't take 1 minute entries everywhere towards that weekly fair value gap. We first need to have those boundaries again. We need to know where we are allowed to go into the lower time frame without getting burned, which in this case is the 1 hour premium array. So if we dive into the 1 minute time frame, then on the 1 minute time frame, we are seeing this fair value gap lower right there. And after that, we have this fair value gap lower right there. So that right there is based on your float, your odd, your lot, what we talked about in the previous video. This right there is already an entry. What do you cover on the 1 minute time frame here? This high? Well, yes, that would be correct if you did not take into account the 5 minute. Because on the 5 minute, what do we see? On the 5 minute, we have this 5 minute fair value gap sitting right there. So if we were to cover our stop loss, then where do we cover it? We need to take into account that we can sting into that 5 minute fair value gap. Even if we didn't do it, we need to take that into account. So covering the bodies right there to then target lower, with the first target being right there. Overall, let's take a nice 1 to 2. We don't need to aim for a lot, just a nice 1 to 2, perfectly fine. And when this price have no reason to return back to right here, well, that is a little bit more difficult because we had this fair value gap above, we had this fair value gap right there. We also had that fair value gap right there. So it takes a little bit more waiting time, a little bit more patience. Once we create this new swing high that is sitting right there, and we create this new fair value gap, that is exactly when price has zero reason to come back. So that is where, if you were holding for longer as well, would be break even by now. And this is at the foundation of basically everything that I do. So everything that I'm doing right here, all the concepts that I'm teaching, they belong in this framework. Again, where other people try to throw 1,000 concepts at you, maybe I'm also doing that. But I will always tell you when and where and how to use that concept, where to apply it. Why do we use it? If I stop doing that, just know I'm likely a fraud. And I likely have no idea what I'm doing anymore. These foundational levels lead you to a trade ID. This is the basics of how we do everything. Now, whether you like it or not, the last piece to the puzzle is time. Submitting to time. Same mentor, time. Consistent. Consistently listening to one mentor. Again, with that time, I mean a minimum a year. Minimum, bare minimum is a year. If we can't submit to time with the same exact concept, then we will never make it work. And hopefully you can now see why, if you use different concepts, if you listen to another mentor, which again, I need to say this as well. I don't want to force you to do anything. There's nothing wrong with that. Don't get me wrong. But if we want you to succeed, then we need to have those rules right there. And of course, if you want to listen to a different mentor, then feel free. I'm not forcing you to do anything. But hopefully you can now see why incorporating those other concepts and why strategy hopping also doesn't work. Because basically you're starting all over again, consistently. Starting that shiny object syndrome over and over and over. Of course, it wouldn't be me if I didn't incorporate another live example right here, where we have this bias. We're coming into that discount array in the overlapping fair value gap as well. We can continue higher off of that. So right here, we have this high as a potential draw on liquidity. Now, right now, how can we capitalize on that? So we focus on now the narrative. We have the draw on liquidity, that premium rate. The narrative, how are we going to deliver there? We're going to the weekly time frame. And on the weekly time frame, we are seeing that weekly fair value gap sitting right there. That weekly fair value gap can now be responsible to first push towards the previous week high and overall push towards new monthly highs there as well. So here, this is now the narrative. Then that is also the boundary, because right now, if we go into the 4-hour time frame, and on the 4-hour time frame, we have of course also established that weekly high, the previous week high was our target. Right now, what can we do? We can now deliver higher towards these highs, which also created our overall entry pattern right there off of that fair value gap, covering the lot right there. If you want to use the odd, then you would have potentially used the breaker right there to then target higher overall. Only thing here is, of course, be careful, because this is NFP at 8:30 a.m. on that Friday. Be careful with that. Other than that, if we just look at price right there, this is exactly what we mean with the foundational levels. We have bias checked off, next boundary, narrative checked off, next boundary, the actual boundary in the form of that weekly fair value gap right there, which also creates that target, the 4th foundational level. 3 and 4 checked off. 5, entry pattern right there, perfectly checked off. Either this one or even this one right there, as long as we get involved to target the overall highs sitting right there and potentially even higher. Because of course, if we enter off the 4-hour here, it turns more so into a swing trade. So off those 4-hour fair value gaps right there, if we get a retrace